Welcome to Talk Tickers. We're diving into Bank of Hawaii Corporation's latest earnings call today.
That's right, Q1 2025 results.
And you're looking for the key takeaways, the essentials. Well, we've got you covered. Overall, it looked like a pretty solid quarter for them.
Yeah, solid's a good word. The main story seems to be continued positive momentum, especially on the interest income side.
Okay, so let's start there. Net interest income and margin.
Both up, and actually for the fourth consecutive quarter, which is, quite a streak in this environment.
How much growth are we talking for NII?
Net interest income grew just over 4.6% compared to Q4, landing at $125.8 million.
And importantly, they managed costs too.
They did. Expenses were controlled quarter over quarter, so good signs on both income and spending.
Okay, what about the balance sheet? Deposits, loans?
Also positive trends there. Period end deposits, they grew 7.3% on a linked basis. Pretty strong.
Wow, 7.3%, yeah. And loans?
Loans were up to 1.1% annualized growth compared to last quarter, so deposits hit $21 billion, loans $14.1 billion.
And any shift in the type of deposits, like those non-interest-bearing ones?
Interestingly, those held stable. Didn't see a big outflow there, which is definitely a positive for funding costs.
Right. Okay, and from a risk angle, credit quality.
They described it as pristine, and the numbers seem to back that up. Net charge-offs were just 13 basis points.
13? That's low.
Very low. And non-performing assets also tiny, 12 basis points, plus capital levels look much stronger than a year ago.
So looking forward, they seem quite bullish on margin expansion.
Yeah, management sounded optimistic. They floated the possibility of hitting a net interest margin, or NEM, around 2.50% by the end of the year.
2.50%. That's ambitious. What's the catch?
Well, it's contingent, right? It depends on keeping those deposit costs in check and potentially getting some help from future rate cuts if those happen.
Gotcha. So deposit costs are key. Where are they now?
The average cost for March was 1.06%. And the exit rate for the quarter was about the same.
Okay, 1.06%. And is there scope for that to come down?
There seems to be. They mentioned a lot of their time deposits are repricing soon. That's a big opportunity to lower those costs.
Right. Let's maybe dive a bit deeper into that. Their overall franchise and market conditions seem really strong.
Definitely. They're still #1 in deposit market share in Hawaii. That hasn't changed.
And they're growing that share too.
Yeah, leading in growth, actually, both short-term and long-term. But they emphasized it's measured growth, meaning they're prioritizing margin over just sheer volume. They want profitable deposits.
Smart. And you mentioned those non-interest-bearing deposits holding up.
Exactly. That, along with other low-yield deposits, is trending positively, helping pull down overall funding costs. Like we said, costs fell for the second straight quarter.
And the Hawaiian economy itself seems to be helping.
It certainly provides a stable backdrop. Unemployment there is still well below the national average.
Tourism holding up. I know Maui was a factor.
Generally stable is how they put it. Still some Maui impact, yeah, but overall holding steady. And the Oahu residential real estate market also looks positive.
Okay, so that stable local economy must reflect in their loan book's health.
Absolutely. And remember, that loan portfolio is overwhelmingly Hawaii focused. 93% is right there.
Only 7% elsewhere.
Yeah, 4% Western Pacific, 3% mainland. It's really tied to the local market. And they highlighted their long-term customer relationships. 60% have been with them over 10 years. That helps credit performance.
In the mix of loans, consumer versus commercial.
Pretty balanced, about 56% consumer, 44% commercial.
And within consumer, is it mostly secured?
Oh, yeah. 86% is secured against real estate. And get this, the weighted average loan to value is only 48%.
48% LTV.
Wow.
And FICO scores.
Also very high. Combined weighted average FICO is 799, so well-secured loans to high-quality borrowers.
Okay, what about the commercial side? CRE is the biggest piece there.
It is, yeah, commercial real estate.
Yeah.
But it's well-diversified across different industries. And again, conservative underwriting weighted average LTV is around 55%.
And the stability in Oahu real estate helps that portfolio.
For sure. They mentioned consistent vacancy rates, flat inventory. It supports that stable market picture. An interesting tidbit. Office space has actually decreased in Oahu over the last decade due to conversion.
Less office exposure then, perhaps, than some mainland markets.
Potentially, yeah. And within their CRE book, no single sector is more than 7% of total loans. LTVs generally between 53% and 56%, very spread out, very conservative.
And their C&I loans. commercial and industrial.
Also well diversified, small average loan sizes, and very, very little is leverage lending.
Okay, let's circle back to credit metrics. You said charge-offs were 13 basis points. Was that up or down?
It was up slightly, came in at $4.4 million annualized, but that was driven by just one single commercial loan charge-off.
Ah, okay. So not a broad trend.
Doesn't seem like it. In fact, consumer net charge-offs actually decreased.
Good sign. What about non-performing assets and delinquencies?
Non-performing assets ticked down slightly. Delinquencies also edged lower. Criticized loans, those ones they watch closely, also dropped a bit.
So the overall cushion, the allowance for credit losses, ACL,
Ended the quarter at $147.7 million, pretty much flat year over year. That puts the ACL ratio at 1.05% of outstanding loans.
Okay, let's switch gears fully to the financials. That net interest margin expansion, 13 basis points to 2.32%. What drove that?
It was really two main things: getting better rates as their assets repriced or cash flows were reinvested, and paying less on deposits. Plus, that negative pressure from deposit mix shift really slowed down.
The move from checking to savings or CDs has eased off.
Significantly slowed, yeah. And that strategy of reinvesting cash flows from maturing assets into securities at current market rates, that's directly adding to NII growth.
Makes sense. What was their fixed asset ratio?
Stood at 56%. And as we mentioned, total deposit costs fell 17 basis points in the quarter. That's a pretty decent drop.
And the potential for more drops looks good with those time deposits maturing.
Looks very good. 74% of their time deposits mature in the next 6 months. That's a huge chunk that could reprice lower.
Are they doing anything else to manage rate risk?
Yeah.
Hedging.
Yep. They maintain their interest rate hedges, about $2 billion notional amount. And they recently added some new ones: pay fixed, receive floating swaps, and some forward starting ones too. Just tools to navigate rate uncertainty.
And they bought some securities too.
They did. Purchased $242 million worth, specifically picking ones that offered a positive spread compared to just holding cash, another NII and margin booster.
So if you add it all up, what's the picture on rate sensitivity?
They had about $7.4 billion in rate-sensitive assets against $10.2 billion in rate-sensitive interest-bearing deposits.
Okay. How about the other side of income, non-interest income?
Came in at $44.1 million for the quarter. Now, that number includes a charge related to a Visa share conversion thing.
Ah, a one-off item.
Basically. If you adjust for that, it was $44.6 million. Still, it was a bit lower than maybe expected, partly due to market volatility hitting trust revenues and fewer customer derivative deals.
On the outlook there.
They guided to about $44 to $45 million per quarter for the rest of 2025, so roughly in line with the adjusted Q1 number.
Got it. Now, expenses. Reported was $110.5 million. What went into that?
Well, some of it was seasonal stuff you see in Q1, like payroll taxes, benefits, expenses. They also got a reimbursement for that FDIC special assessment, which helped offset things a bit.
Offsetting increases elsewhere.
Yeah, they saw increases in variable incentive pay and also medical costs. Looking ahead for the full year, they expect core expenses, sort of the underlying run rate, to be up maybe 2-3%.
And Q2 specifically will see a bump.
Yes, Q2 includes their annual employee merit increases, which they estimate will add about $2 million to the expense line for that quarter.
Okay, so pulling it all together, the bottom line, net income, EPS.
Net income landed at $44 million. Earnings per share was $1.97. Both of those were up from the last quarter.
And return on equity.
Return on common equity was 11.8%. A pretty solid return. They also set aside $3.3 million as a provision for credit losses.
Tax rate
was 21.67% for Q1. They expect it to be closer to 22.5% for the rest of the year.
And capital remains strong. Any changes there?
Capital looks very healthy. Tier 1 ratio is 13.9%. Total capital is 15%, well above requirement.
Returning cash to shareholders.
Yep. Paid out $28 million in common dividends, plus $5.3 million for preferred stock. And they declared the next common dividend at $0.70 per share, same as before.
And there was a management change announced, too.
That's right, a significant one. Dean Shigemura, the long-serving CFO, is retiring at the end of June.
Who's stepping in?
The current deputy CFO, Brad Sottenberg. So an internal promotion, which usually signals continuity.
Okay, let's look ahead then. What were the main guidance themes or macro trends they discussed? Tourism, obviously key for Hawaii.
Very key. They flagged potential headwinds, maybe from Canadian traffic due to tariff sentiment, also some uncertainty around the Japanese market.
But U.S. domestic travel is okay.
Seems relatively strong, yeah. So the baseline forecast is for roughly flat visitor numbers for the year, but they acknowledge downside risks depending on the economy and those tariff issues.
And loan growth. What's the expectation?
Still guiding to low single digits. They said the commercial pipeline looks solid and maybe a bit of a pickup in consumer mortgage and HELOC applications could help offset some runoff.
But cautious.
Definitely cautious. They mentioned the uncertain environment and how pipelines can shift quickly. So hoping for low single digits, but aware it might not be a straight line.
You mentioned tariffs impacting tourism sentiment. What about direct tariff impacts on their loan book?
They looked into it. Their analysis suggests maybe 4% of the loan portfolio is in industries that could be directly impacted.
Only 4%.
Yeah, but they think the actual impact will likely be limited. Because Hawaii's economy is so service-oriented and their C&I portfolio is diverse with small average loan sizes. It's not heavily concentrated in manufacturing or directly tariff-hit goods sectors.
Right, makes sense. Okay, so let's step back. For investors listening, what are the key takeaways? Consistent NII and NIM improvement looks pretty good in this environment.
Absolutely. And that pristine credit quality, those low LTVs that suggest really disciplined risk management, you have to like seeing that.
And they seem proactive on managing rates, too, with the hedges and security purchases.
Yeah, they're not just letting rates happen to them. They're trying to position strategically. And that slowing deposit mix shift, plus the potential for lower costs from TD repricing those are definitely positive signals for future profitability.
Expense control remains a focus, though they're still investing.
Right, balancing efficiency with necessary investments. And the capital ratios provide a nice cushion. The CFO transition is something to watch, but having the deputy step up smooths that out.
Okay, now for our favorite segment. This is not financial advice. Purely speculative thought experiments here. What kind of wild but plausible trade idea springs to mind based on this call?
Okay. Not advice. But you look at Bank of Hawaii's unique market, that stability, the strong local ties. Maybe you lean into that.
How so?
What if you went long Bank of Hawaii, BOH, betting on that local strength, but hedged against broader economic jitters? Maybe short, something exposed to more volatile mainland consumer spending? Like a big national cruise line operator.
Interesting. So BOH long, cruise line short, betting on Hawaii tourism holding up better than, say, discretionary cruise travel in a potential slowdown.
Kind of. It's a play on relative resilience. Bank of Hawaii is tied to Hawaii's specific ecosystem, which might be more insulated than companies relying on broader, perhaps more fragile consumer sentiment across the mainland U.S. It's a local versus national play, in a way.
A bet on the aloha spirit versus the open sea. Definitely speculative.
Totally speculative. Always do your own research. Don't trade based on podcast banter.
Absolutely. So that wraps up our deep dive into Bank of Hawaii's Q1 2025 earnings. We hit the key results, market conditions, credit, financials, and the outlook.
Yeah, a lot to digest, but hopefully that gives you a clear picture of where they stand. What are your own thoughts on BOH? We always encourage you to dig deeper.
Thanks for tuning in to Talk Tickers.